All right, welcome back to Nadlin Forum Podcast Daily. I'm Ruby Sturt, joining you from, good old Melbourne, though the accent usually gives that away. Liars here as usual, ready to dig into the latest numbers that have all the headlines buzzing. So today, we're talking about something a lot of folks might not feel until they start paying more for, like their phone or that new blender, the huge spike in US tariff revenue, and I mean huge.
Yeah, it's wild, Ruby. The US Treasury just reported that tariff revenue shot up 142% this year. We're talking $202 billion, mostly thanks to those expanded tariffs on Chinese goods, European cars, tech components. The list goes on. And get this, in September alone, customs duties hit $30 billion. That's almost 300% up from last year's September.
I mean, that's not just pocket change, is it? I have this quick story. Bit embarrassing, actually. So, last month I went to grab a new set of noise-cancelling headphones. Nice imported brand, right? I nearly keeled over at the checkout. The price tag was like full-on shock therapy. And honestly, it was mostly because of all those new tariffs tacked on. It's easy to see these numbers and forget they, trickle right down to the average person, me included.
Yeah. And I hear that from clients in New York all the time too. Tariffs definitely make their way into store prices. The government's argument, of course, is that these tariffs boost revenue and theoretically protect domestic industries. But like you said, Ruby, for anyone buying imports, electronics, appliances, whatever, these policies suddenly get a lot more real.
Exactly. And from an investor perspective, that $202 billion isn't just a blip. It gave the Treasury a nice boost, especially with their deficit still ballooning from all the debt. So we've got record customs duties, $198 billion surplus just in September from higher corporate taxes, and some clever timing on payments. It's like they really wrangled every last cent to ease that deficit, yeah?
Yeah, no question. The numbers would have looked a lot worse without those tariff collections. It's a real-time test of how policy, trade fights, and global tensions can directly shape the fiscal landscape in Washington, and in our pockets here too. But tariffs are only half the story. Even though the deficit dipped a little, down to $1.78 trillion, and that's about a 2.2% decrease, it's still just incredibly high by historical standards. We're talking nearly double the typical deficit to GDP ratio at 5.9%. What really jumps out to me is that interest payments on the national debt passed $1.2 trillion this year. That's more than what the US spent on defense, by over $50 billion.
That's mind-boggling. Like when you sit down and work out what that means for what the government can actually spend money on, it's stark. Most of that budget is locked up in mandatory stuff, Social Security, Medicare, Medicaid, and now just paying off interest. There's not much wiggle room left for, say, infrastructure, education, things that, we always hear about in election season but rarely see funded the way they should be.
For sure. And look, I've seen a smaller version of this maybe 15 years ago back in Israel during one rough fiscal cycle. When the debt payments start crowding everything else out, it's the social safety nets, the innovation programs, almost anything that isn't a legally required payout that gets squeezed. You start feeling it at every level. Higher taxes, slower services, even less support for new businesses. It all starts with the cost to just maintain the debt.
I mean, to make it really simple, if your credit card bill is all interest and you can't pay off the stuff you actually bought, eventually you're just stuck. And that's where the US is headed, unless something gives. It's such a delicate balance, trying to cut the deficit, but not at the expense of services or economic growth.
Yeah, and even though there's a slight improvement, quoting the Treasury Secretary here, falling under 6% deficit to GDP ratio is seen as a positive shift, but the absolute debt just keeps growing. The government pulled in around $5.2 trillion, but spent over $7 trillion. That gap It just keeps adding to the mountain of debt and interest.
And it's not like all those new tariffs or higher tax receipts are a forever fix. The big worry is structural, aging population, everything costing more over time. All this stuff sits quietly in the background until it suddenly isn't quiet at all. Bit like what we saw with disaster spending in Indiana and Michigan last episode. One shock and the cushion disappears. So, okay, tariffs bring in a boatload of money, but it's not exactly a magic bullet, right? If you're a real estate investor or just trying to buy a laptop, those higher prices can really sting. Sure, the government's coffers are up for now, but everyday people and most small businesses, they're often the ones footing the bill via price hikes on essentials and everyday goods.
Absolutely. There's this ongoing debate in Washington about whether all these protective policies, tariffs, certain types of tax incentives, genuinely support American industry, or if they're just shifting costs. Some say we're strengthening local businesses, but others argue we're slowing the whole economy and raising costs on everyone else. From what I see, it's, never that simple.
That's spot on. And it doesn't help that there's another big X factor right now, the Federal Reserve. With talk about potential interest rate cuts ahead, there's this hope that future debt payments could ease up a bit, maybe help the numbers look better for a while. But then you get the inflation worries and it starts sounding a lot like what we covered back in our core inflation episode. It's like whack-a-mole. Fix one thing, something else pops up.
Exactly. So what does it mean for the folks listening? Especially those who invest in real estate, run a small business, or just want to know if they should expect more surprises next time they walk into a store. If rates drop, maybe mortgage payments get a bit easier in the future, but those broader debt and fiscal pressures aren't disappearing. Investors need to keep their eyes out for both new opportunities and new risks as these changes play out.
Yeah, it's a moving target for sure. And whether you're tracking global trade, local property trends, or just your own shopping cart, these policies have ripple effects. Guess we'll be keeping an eye on it all because there's no sign any of these debates are cooling off soon.
No way. And as always, we'll keep unpacking what it means for you, so don't miss the next one. Ruby, always a pleasure.
You too, Lior. Thanks for tuning in, everyone. Stay smart, and we'll catch you back here next episode. Bye.